to the another Wealth Builder Masterclass. We are super excited to have you with us. And I'm your host, Vinky Loomba. Before we get into the numbers or the tax code sections today, I wanted to ground this conversation in something very, very real. Most high income earning professionals that I work with, they're not upset about paying taxes, but I think what frustrates them is this harder concept, they work so hard, they get promoted, they take more responsibility, and yet they do not take the same proportion home. So I think it might sound familiar to you guys, and if it does, you're at the right place today because today is not going to be about loopholes or aggressive tactics. It's going to be about understanding how the tax code actually works and how real estate fits into this framework so you can make informed and compliant decisions with confidence. And to help us with this conversation, I'm joined by my good friend, Vince Porter. He's the president and managing partner of Porter and Company CPAs. Vince works closely with real estate investors and private funds across the country and brings a practical, real world perspective on how tax strategies actually play out. So, today, our goal is really simple: education, clarity, and perspective, nothing else. So, welcome, Vince. I'm super excited to have you with us today.
Spanky, I'm glad to be here. One of the things that I really enjoy is kind of sitting out here and talking and educating people. And, I try to make this a little lighthearted and fun and kind of show the bottom line of how I view taxes and hopefully, your listeners will get a little bit out of it. But yeah, I appreciate you having me.
Yeah, of course. So I think before we get started, let's go through a small little disclaimer. So this session is strictly for the knowledge sharing purposes and should not be considered as a legal, accounting, or investment advice. So if you have some specific questions regarding your taxes, your investments, please reach out to your CPAs or actually reach out to Vince. He'll be a good resource for you. And other than that, I have a small little housekeeping items over here. So if you have any questions throughout the presentation, don't hold yourself in the end. Just use the Q&A box and put your question there because we'll monitor the Q&A box and we will try to address all your questions as we move through the presentation. And if we didn't get to answer any question, please go ahead and email me at vinky@lumbainvest.com and I'll make sure that I respond. Okay. So with that being said, Vince, I'm gonna let you take over the stage and go for it. And introduce yourself as well. Tell us a little bit more about yourself as well as you move along.
I will. Let's see if I can get this going. Shoot. All right. You guys see my screen?
Yes.
Good deal. Well, it says on unlocking real estate tax secrets, but we're really going to talk about the tax code and W-2 earners, but a little bit first about who I am. My name's Vince Porter. I'm the president and managing partner, as Vicky said, of Porter and Company CPAs. We are a 16-person firm in Dallas, Texas, and we do cater to high net worth entrepreneurs in real estate syndication groups and funds throughout the country. I've been doing this for about 20 plus years, and not only am I a CPA and know the tax law very well on this side of the desk, I'm also an investor, a real estate investor. We've invested passively with several of our clients. So I feel like that gives us a kind of a unique leg up to help our clients because we're in some of the same deals they are and we can see things from that side of the fence. But ideally, the big thing is our motto is our client's success is our success. I can't stay in business for 20 years or another 10 years from now if our clients aren't successful. So the way we do that is obviously one, ensure compliance, but two, help them build wealth through understanding the tax code and how it applies to them. So kind of today is about that and answering some questions that I think some of you might have. And giving you my perspective on it and, answering any kind of questions you guys might have. So, um, I'll start here. Why high earners feel overtaxed? Well, if you look at the tax rates, they're obviously on a progressive scale. So the more money you make, the higher the income tax. And once you get to a certain threshold, you're taxed at a cap of 37% on the federal side. You could have some additional Medicare taxes to get you closer to 40. If you're like Vinky and live on the West Coast in California or New York or a high income state tax, it's even higher. So if you're on a W-2, you've got a really high salary, you're going to be taxed at the highest rate. But here's what we want our clients to understand and how we look at the tax code. If you do something to give back to the government, there is undoubtedly somewhere a tax credit or a deduction or some sort of incentive aligned to make that happen. For example, if the government wants to reduce our dependence on foreign oil and wants to start pulling back a lot of that, they will give big deductions for promoting domestic oil production. If they want us to go green, they'll give you a tax credit for buying a Tesla. If they want to promote real estate, they've got immense amounts of deductions and strategies that apply to real estate, whether it's 1031 exchange, whether it's lower long-term capital gains rates, whether it's 1031 exchanges, cost segregation, depreciation, on and on and on. At the personal level, you can deduct your mortgage interest and your real estate taxes. All of that is tax legislation driving the economy. And whenever I hear someone say that we're going to go to a flat tax, we need to go to a flat tax, why do billionaires get all these tax breaks? Well, here's the thing, we're all playing off the same sheet of music. The same tax code that Elon Musk and Steve Jobs back in the day and Warren Buffett, all of those people have the same rules that you're afforded. It's just that they use it differently than you. So, um, fundamentally, if you're on a W 2 and that's all you are on, your options are narrow as to what you can do in terms of deducting or maximizing the tax code. It's really not built for you. And the reason is because businesses and investors drive the economy more. So there are more tax incentives aligned to them. So if you're on a W-2, that might sound discouraging, but there's ways to get around that. And that's kind of what we want to go through today. And my goal really is to simplify this down for you. I don't like when CPAs come over the top and start quoting tax code and code section 469 and telling you all the nuances of material participation. I want to simplify the complex and bring this down to a level. You're hiring us to bring us on to help you and advise you. We want to make sure you understand these types of strategies, what can apply to you, and if you can get a little bit of that education or at least know where to look, it's going to allow you to have a more tax efficient tax return, reduce taxes, increase wealth for you to continue to either build businesses or invest in other things and increase your wealth. And that's kind of the bottom line of what everything's about. Right? So
Yeah.
why does optimization matter? Why is it important? I always tell our clients there's a lot I can do for you on January 22nd today for 2026, but there's not a whole lot I can do for you for 2025. That calendar year's done, it's gone. So if you are proactive in the way you approach your tax returns and the way you approach advisory, you are going to be aligned way better. The tax code's roughly 70,000 plus pages. I'm not going to pretend that I know all 70,000 pages, but what we do know applies to our the niches that apply to our clients, and we know it very well, and we can align them and speak to them in a simple manner so that they can understand it and kind of go through and pick out the things that matter most to them and that they can save taxes on. So advisory is big in our firm. I think it's really the future of where we'll go as an industry, because I do feel a lot of the just the compliance of preparing tax returns and reconciling bank statements, that's table stakes at this place. You've got to have that stuff done. You don't want to we don't want our clients coming out to us and having a dentist type experience where they hate seeing their CPA because he's in the weeds and he's not giving them any advice, and they're always filing late and they're always getting surprises. That sucks. So we want to be out in front of it. We want to be proactive. We want to be able to have conversations on an ongoing basis. And if we're able to do that, you're able to see way much more value and way much more benefits to that. So um I kind of move this all around, Vinky. I know you've got kind of a highlight of where you want me to go, but if you want me to stop and pause or redirect anything, just feel free to jump in and go through that. I can kind of pick and choose where we go from this, but I've got
Yeah,
anything we can go with this, right?
yeah, sure. Just go ahead your slide deck, and as we move along, I can ask you the questions in the middle, and then if any questions we have from the audience, we'll also address those.
Yeah, yeah. Well, I like to show this slide. It's kind of geared more toward real estate, but it illustrates the fact of what taxes can do to your investment returns. So in this simple bracket, what we do is we show a simple $10,000 investment made today that earns a 10% return, and it's taxed every year at the 37% bracket, the top bracket. So if you put $10,000 in with those parameters at the end of 30 years, you will have $62,000. $10,000 growing at 10%, taxed at 37% every year, will grow $62,000. So $82,000 in growth and 30K in taxes. It's okay. It doesn't feel mind blowing, but it's something. Let's build in some tax-free returns. Same parameters. $10,000 invested, 10% return, but let's say you pay a 0% tax. That same $10,000 grows to $174,000. That's three times. And you might say to me, Vince, there's no tax-free returns out there. Well, I can show you a lot of ways to get to this. And this is trying to illustrate, if you're efficient with your taxes and you're not in heavy tax situations, or you're planning for this, you can compound your wealth. And then in the real estate market, well, obviously they use leverage a lot. This example shows that if you take that same 10% down, borrow another 40%, so leverage yourself at 80% at a 5% interest rate, that same $10,000 is going to grow to $434,000. That's the power of leverage. That's what $50,000 can do for you, and tax-free earnings can do for you. So, that's just a quick illustration and kind of show you, real estate can do this for you. Real estate can put you into 0% brackets if you structure it right. I'm not going to sit here and pretend like it's easy. Everyone can do it. It takes work, it takes planning. But if you have $10,000 that you can grow to almost $500,000, or you can grow it to $62,000, which would you rather do? That's what smart, efficient investing can do for you, and it can compound your wealth. So let's talk a little bit more about real estate and how those work. So I would like to redo this slide because I told you I don't want to get into the details of this, and it feels like I got way too many numbers. But stay with me for a second. I promise I'll try to make it easy for you to understand. So if we're looking at your personal tax return, the IRS taxes you in three different ways. They tax your active income. This is going to be your W 2. This is going to be your business income that you're actively involved in. They tax your portfolio income. This is going to be your interest, your dividends, your activity in the stock market from your brokerage accounts, your IRA distributions, your pensions. Then they tax your passive income. Passive income is any income that you are not involved in the day-to-day operations of and real estate. The reason this is important is that when you have a loss in a passive activity, it cannot offset your active income. So we have a lot of clients that usually come to us that were told by syndicators or they read online that if they invest into passive multifamily deals, they're going to get big depreciation. And then they took their K1s to their CPA and it didn't help them at all and they don't understand it. Well, this is the reason. You have passive losses, you can't offset that active income. There's ways to do that, and we're going to talk about it. But if at the end of the day, if you've got a loss on a K1 coming in from a passive activity, whether it's real estate or not, it can't offset that W 2 income. So, some of the ways you can get around that are this: one, you can be a real estate professional. The real estate professionals highlighted over here mean that you really truly need to be actively involved in real estate. So, big picture, what that means is step one, you have to spend at least 750 hours working in real estate in some capacity. That could mean, flipping units, that could mean leasing out tenants, that could be raising capital. There's a lot of things that could qualify as real estate um, professional status for that 750 hours. The second piece, which trips everyone up who has a big high earning W 2, is that 50% or more of your personal service time must be in real estate or more. So that means that if you are a radiologist making a W 2 and you're working 50 hours a week in your radiology job at the hospital, to be a real estate professional, 750 hours is table stakes. You still have to meet the 50% rule, which means that you have to then spend 50 hours or more in real estate. For the radiologist in this example, that's virtually impossible. And that's why the IRS set it up that way, is because before 1986, a lot of wealthy people were abusing this and taking advantage of it. So, people like me, a CPA, if I invest into a passive deal with Venki and I get big losses, I'm not going to be able to use those losses because I'm not a real estate professional. And I don't intend to be. And I can't fool the IRS that, if I work 50 hours a week in this practice all year long, I'm going to be able to do the same in real estate. It just won't happen. But a way around that is if you're married and your spouse does not work, then all of a sudden they have no 50% time. All they need to do is qualify for that 750 hours. And once they can meet that, you've got step one, the bigger the green circle taken care of. Then you have to move into material participation, which means each individual property and real estate needs to be looked at. And are you contributing enough hours to that? And I won't get into much in the weeds in that because basically, if you're meeting the 750 hours, you're probably meeting material participation. But I will say this, that if you have multiple properties, if you've got a lot of real estate property you either own individually or all by yourself or either passive investments, each one of those items has to be looked at individually for that material participation role, which means that you usually have to have at least something like 100 hours. So as you scale up per property, as you scale up, if you have 20 properties, and you've got to prove you're doing 100 hours on each property, you're not going to be able to do that. So the IRS allows you to group all of those activities into one singular unit if you would like and use all of the hours. And then that can qualify all of those hours to meet for the material participation. And you can just meet this 750. So
Um,
that's an option for you if you're on a W-2. If the spouse can qualify for real estate professional status, that can be a big unlock for you. But, your spouse may not want to do that. If that's the case, then there's other options you can look at, and perhaps maybe you have a business. The big thing is, I should back up. If you've got passive losses, and you're not able to offset that against your W 2, it's not that you lose those losses. Those losses are what in the tax code is called as suspended, and they are carried forward indefinitely until a couple of things happen. Either you have passive income, that unlocks the passive losses to offset that passive income, or you sell a property or dispose of it or dispose of a passive activity. At that point, all the passive losses from that activity would be unlocked and it can go against non-passive income. So, going back to my situation, if you've got a spouse that can qualify for real estate professional status, it converts those losses from passive to non-passive. You can offset against your W-2 income. If you can't do that, then you got to figure out a way to get passive income. And that becomes a little bit more of a challenge. But if you've got a business, it's very possible that one or more of the people filing on a husband and wife tax return, one of the spouses may not be actively working. There's a chance you could qualify one of them as passive and align passive losses and non-passive losses. But for the interest of today, just know that you kind of have to have a rough understanding of that. And if you've run into that before, then that's what's occurring. But that doesn't mean that there are not unlocks to get to this. We've got clients that have structured deals so that passive losses align into other entities or trusts or things like that. As long as we can find or carve out the passive income in businesses or structures or anything like that, you can unlock those losses. And that's important because going back to our schedules over here, if I can save tax dollars for you today, that's way more valuable to you than tax dollars 15 years from now or 5 years from now, right? The time value of money comes into play. So we want to work and figure out a way to unlock those losses so that you can lower your tax rates and get yourself into a better situation.
Thank you, Vince. And I do have a few questions here on this slide. I mean, this is a very important information that you have shared with everyone. Passive and active, and then passive goes with passive, active goes with active. That's the basic that everybody needs to understand that. So now, last year, before I get into, I do have questions in the Q&A as well. Before I get to the questions, I wanted to ask you this question. Last year in December, and this happens every year with me, a lot of people, they are just kind of jumping. They're like, okay, do you have a deal? Do you have a deal that can give me the most appreciation? But unfortunately or fortunately, you can call it, they are the W-2 employees and they cannot use that depreciation that we gave by the end of the year, like by December 31st. So for them, there's only this route. If they can take the spouse route or whatever route they can take to get to the real estate professional, that's the only way they can leverage that, right? The depreciation or the bonus depreciation. And that's what I'm hearing from you. There's no other way for them to get the tax shelter for their short-term income. I would call it, that's the W-2 income, because they do not have any active losses uh, to offset that. I
Well,
may have active losses some, but not exactly 100% to offset that.
not exactly. I mean, obviously, the real estate professional status, if one of the spouses can qualify that and move all the pieces together and make that work, then yes, that will work. If they don't have that, then The next option I would look at as an advisor for them is, do we have business income? If you're solely on a W-2, then that there's probably not much else. But maybe you've got a maybe you're the radiologist with your own practice, and you manage your own business, and you've got business income in addition to that W-2 income. Then there's some strategies we can align to carve out some passive income from those businesses that can then be the unlock for the passive losses that are coming through. So that's a strategy we can employ. But I don't want to say that all is lost. If I think the deal is good, Vicky, and I agree on it, taxes are a big player in that, and they should be considered. But you know, I would rather be in a deal that makes money, and you're going to turn this thing around and double my money in a few years versus just reaping the tax benefits. And trust me, I'm living and breathing. I've got a couple of deals that have gone completely to zero, and that sucks. Tax benefits were great, but still the tax benefits were 30% of my original investment. I would rather have the whole investment back and have paid the taxes. So, you know, there are situations where maybe a passive investor or an LP, maybe they sold out. Now, I know there wasn't a lot of sales in the last few years given the market, but maybe they sold something and maybe they've got some big passive income. At that point, obviously going back to those suspended passive losses, can we unlock those? And if we can unlock those, great. Does that get rid of all those gains? If not, all of a sudden you've created a situation where you've got passive income. So we call that strategy layering your investments. Whereas, let's say I sell out of a deal here in 2026 and I got a big capital gain. That capital gain is passive income to me. So I could go back to you, Vinky, at the end of the year throughout the year, and you've got a great new project in South Dakota that's going to kick off a lot of depreciation. If I invest in that, you're going to give me a K1 with a lot of losses because I assume you're going to do a 1031 exchange. And then I'll be able to offset those losses against those gains. So, there's with all of this, there's so many moving parts. It's never a yes or no answer, right? There's a lot of different things. And when you're investing and when you're tax planning, it's not just a moment in time we're looking at. We got to spread our horizon out and look over the picture. Maybe I am expecting a big capital gain to come in 26, and I know I'm going to need some losses, and I'm not sure what's going to be out there available to buy. But I like your deal in December of 25. I can get into that deal, and maybe for me, those losses would be passive. I can't recognize them in 25 for whatever reason. They carry forward and offset my gains in 26. It's a big picture you need to look at. And a lot of CPAs and get stuck on a hamster wheel of just compliance, compliance, compliance. We got to do the tax return in front of us, but that's not the way all this works. It's a broad horizon, right? When we do our high value advisory services, I'm not tax planning for 1 year. We want to look at what's coming down the pipe in 2 years, 3 years, 5 years. Then we can make a lot better decisions.
Yeah, no, I like that. And then plus, if you're 100% W-2 employee, there is still you got some cushion on the 401k side, right? You can do some like in-service rollover, or you leverage your 401k to grow wealth there because this is like a wealth building strategy. The way you are mentioning, it's not like right here, right now that you wanted to use all the deductions. It could be long term as well that you can, when you have the losses, you can offset your passive gain down the road at some point. So at this point, I wanted to ask you this question too. Somebody asked already in the chat, how about the short-term rental or the hotels or the Airbnb? Are those considered as a short-term active income that W-2 employees can offset against their active income?
They sure are. Yeah, where are we at? All right. So here's my slide. You either heard my presentation before, you've seen the TikTok short-term rental loss loopholes, right?
Okay.
Okay, so everything we were just talking about with passive losses in the real estate world applies to your typical rental market. Your people that are renting long term, and by long term, the IRS defines that as 30 days or longer. So, your typical tenant that stays in an apartment or a house for a year is long term. All of that is subject to the passive activities we just discussed. Short term rentals and hospitality is viewed differently in the tax code. Short term rentals, meaning if your average stay is 7 days or less, the IRS views that as hospitality or hotel, and it's different from real estate professional status. When that happens, a person with a high W 2 can buy an Airbnb, and as long as they materially participate in that, and that means in a short-term rental situation, Airbnb, Verbo, that means you're not outsourcing everything you do to the property manager. You're going to have to do a little bit of work, manage the bookings, things like that. You don't have to go clean between each stay, but if you are managing the bookings and at least putting in 100 hours a year into that, you can turn those losses from a short term rental into non passive. And that's a big unlock because a lot of people may not want to qualify for the real estate professional status, right? Because 750 hours a year is roughly 15 hours a week. If you've got a spouse that just isn't willing to do that, then that's not a strategy you can really employ. But if you are doing the majority of the work in your short-term rental, meaning you're um, managing the bookings on that, then those losses can be offset against your W-2 income. And cost segregation studies are not just for big multifamily commercial property. They can be done on single family houses and short term rentals as well. In fact, we've got a lake house that we have a short term rental, and we've taken these same benefits for our side as we have managed the bookings for that and realized the losses, and we've been able to benefit from that. So short-term rental losses are the short-term rental loopholes a big one. It's a big way to beat passive losses. And here's the thing: you may look at this and say, "Well, I don't want to manage a short-term rental forever." You don't have to. The way a cost segregation study works, which I'll quickly hit this if anyone doesn't know it, but essentially, when you have a piece of real estate, you can depreciate everything that's built up on that property. You can't depreciate the land. The IRS says that never goes down in value, but all of the other assets, the components of the building, are depreciable. And for short-term rentals and multifamily, that standard is 27 and a half years. So if you take whatever you bought the property for, you can depreciate roughly 3% of that a year. That's about what 27 years works to be. But everything inside that property is not subject to 27-year property. Some of it, like HVAC systems and roofing and tile and interior finish out, some of that has 15-year property, 7-year life, and 5-year life. And when that happens, that stuff falls into bonus depreciation territory. And that is all subject to 100% bonus depreciation. And that's a powerful unlock. So when you do a cost segregation study in a multifamily or a short term rental, you get a big write off in the year that you put that cost segregation study into place. So we've had a lot of clients that have taken a short term rental, taken the big write off in one year, and then the next year they turn this over fully to a property manager because they don't want to deal with a headache. They already recognize the tax benefits. The future benefits are going to be losses, but they've already gotten a big sizable deduction out of it. Most of the things coming through now would be considered income if the short-term rental is profitable. So it doesn't really matter if you've got passive income. It kind of creates a situation where, going back to my strategy of, if you've got passive income, you can have other things to offset it. That's where we can come in and start layering in some passive losses from some other deals. But that's just a kind of a way we've advised some of our clients to do it.
So there is a question, does that mean that short-term rental needs to be close to where one lives, or just managing the booking is good enough?
Just managing the bookings. I mean, we have to get to material participation rules, right? So material participation rules says that you would provide most of the hours in servicing that unit. So, I'm sitting here in Dallas. I could have a property in San Antonio, which is 4 hours away, or a property in Napa Valley by you, Vinky. And as long as I'm managing those bookings, um, that would suffice. Obviously, I don't have to be going out there and doing the um, cleaning between tenant turnovers. You could do that, but as long as you're doing sufficient enough work in advertising it, promoting it, working on the back end to manage that thing, managing the bookings, you should have enough time to qualify for that. So no, it doesn't have to be in your own backyard to qualify for that.
Okay, so you can basically, what you're saying is you can use portion of it against your active income as well to offset that, right?
Absolutely. Yes. Yeah.
And then same goes for the hospitality as well, right?
It goes for hospitality. Yeah. Yeah. The challenge with hospitality would be that, you're having to, if we're talking about a big hotel, that's a big operational business. So again, if you're just putting up money in a passive sense, it doesn't matter if the activity is hospitality or real estate or anything. If you're not putting any time into it, or you're not putting time into other things that can group all that stuff together, it could be passive. But if you've got a hotel and you're operating it, absolutely that could be qualified as non-passive. It's just the short-term rental provides you a little bit less work. I think running one Airbnb property is way different than a 100 door Days Inn or a Holiday Inn, right? There's a lot of different factors that play from that, but it could work if you put in the time.
That's true. And I think hospitality will be considered as a business because it kind of day to day, running business that you're managing. And that will be more like active or short term kind of thing. That's the way I think I understand. But there's another question. Can active losses cut into portfolio income also?
And passive losses offset portfolio income only if those capital gains are passive. When we're talking about portfolio income, so dividends, interest, IRAs, no, passive losses can't offset that. If you've got capital gains that are coming from a passive activity, that can offset it, but passive losses can't offset your a good portion of your portfolio income. Active losses can, yes, not passive losses.
So how about if somebody has rental units, beside whatever they're getting the bonus depreciation from the syndication, but they might have their own rental portfolio and they might have some income, monthly income from that.
Yeah.
Would they be able to offset that?
Sure. So in this situation, I'm going to make a couple of assumptions, but we talked about material participation, and in your active properties, let's say it's a husband and wife couple, one of the spouses probably doesn't need to work if you want this to happen. So, in that assumption, if one of the spouses doesn't work and they manage one of these properties and put enough time in to qualify for material participation and can get up to the 750, what you can then do is start grouping all of your other real estate activities into it, whether it's passive activities from loss from multifamily investments you've been an LP in, other properties, you can group that together. Again, I said material participation has to stand for each individual property. And in a basic sense, that means you need to spend about 100 hours for each property, but that doesn't scale very well once you get up there. So the IRS allows you to group all of those activities together and count it as one. And that is kind of the unlock that if you've got a couple of real rentals on your own that you actively manage, you can then start pulling in some other activities that might otherwise be considered passive. You can group all that together and get them unlocked as a non-passive activity by grouping all of your activities together to establish material participation.
Okay, so let's move on to the next question. Is please clarify the depreciation offset upon sale of an asset that has taken accelerated depreciation and the effect of the proceed upon sale.
All right. Well, depreciation recapture, right? What goes up
Yeah.
must come down. So, um, I don't know if I have a slide. I'm not going to move through here, but maybe I can say it eloquently enough. So when you buy a property, whether it's a single family rental home for yourself, for your own investment portfolio, or you're an investor in a big multi-million dollar multifamily commercial property, you buy the asset at a certain amount. Let's say you buy it $1 million. Every year you take depreciation, including these big depreciation write-offs we take from cost segregation, that reduces your tax basis. So in my example, if you buy a property at $1 million and depreciate it down to $400,000, your tax basis is now $600,000. So if you go out in the market and sell this again for $1 million, in your mind, you're probably thinking, I made no money on this deal. I bought it for $1 million and I sold it for $1 million, but you got to take $400,000 out in depreciation. Your tax basis is $600,000. So you will then pay a capital gain of $400,000. And that's what depreciation recapture is. So, um, the way that's simply the way that works. Again, depreciation is just a function of losses. So if in the example we were just explaining earlier, um, if you've got suspended passive losses that were generated from depreciation, it doesn't matter if they're operational or depreciation, there's no difference there. If you've got suspended passive losses, those will unlock and you'll get to take those at that time because you've got a passive income from passive activity. So in a passive situation, that's the way that would work. If you have already taken those losses, some clients will say, well, why would we do that if we just have to pay that money back? Well, you have to look at the timeline because if you can save 37% today on $400,000, that would save you what, $150,000 somewhere in there. I use a calculator. I'm not good at math as a CPA, but I think let's say it's $150,000. Is $150,000 to you today more valuable than 5 years from now? Of course it is. It's a time value of money. So when people argue that they don't want to take accelerated benefits of depreciation early on because they're just going to be subject to recapture, I will say you have to look at that arbitrage too, because if I save 150 today at 37% and I have to pay it back in 5 years at a long-term capital gain of 20%, I've got an arbitrage between 37% saved today and 20% in the future. I still netted a total of 17% savings on that. Plus, I got that money in this example 5 years earlier. So I'm always been a big bit a proponent of taking that depreciation early. The only reason I would say not to is if you were going to flip it or you are going to sell it in 12 to 24 months, then maybe the juice isn't worth the squeeze. But essentially, that's the way depreciation recapture works, and that's kind of my philosophy on why I still think it's a good idea to take that.
So, but how do you handle the recapture at the exit? Would it be beneficial to go ahead and do like invest somewhere else or 1031? Is there any suggestions there?
Well, that's why we're in business, Vinky. That's why I'm over here advising taxes, and you got new deals for us. As I said earlier, if let's say you're sitting on a situation where you've got a deal that's exiting and you're making money on it because you've got depreciation recapture, you've got a capital gain, you got a few options you can do there, but one of the really basic ones that we advise all the time is what I call layering your investments. If you invest into a new deal that's kicking off depreciation, and even if those are passive and the new income is coming in as passive, I can match those up and I could save money on that. So you can layer your investments like that really easy. Obviously, there are other things like 1031 exchanges and this, that, or the other, but that's a lot of, we don't have to get into those sort of things, but for an LP, that's the easiest way to do it is just layer your investments is go buy a new one.
That's
And now we have opportunity zones coming back into play. Those
mhm.
will start back up on January 1st of 27. And if you know anything about opportunity zones, those allow you to defer your capital gains for up to 5 years, as long as you reinvest that gain within 6 months of your sale. So if that window opens up for the new version of opportunity zones in Jan of 27, that means anything you sell from June onward this year, you could do an opportunity zone investment into the next year and defer those taxes on that. And then opportunity zones are a whole nother thing and a way to defer taxes, but those are coming back online, and that's a strategy we will probably start recommending if people want to get into that.
Yeah, no, I did that one last year, and I think that was really good because we were still in the time limit for that one. But that is phasing out, I think.
The
That already
old
phased
way,
out.
yeah,
Yeah,
the old way phased out this year, right?
yeah, this
So
year is
now
phasing. Yeah.
So,
Mhm.
so in 25, if you had to exit, you're really only deferring tax for maybe 12 months. It's something, but you could still get that big long 10-year tax-free return. But starting back in 27, it starts up again. The Opportunity Zone 2.0 that was a part of the One Big Beautiful Bill, it will allow you to get that 5 year window. So if you have a capital gain in, let's say, the back half of 26, you reinvest those capital gains into an opportunity zone, you will not have to pay that tax back for 5 years. So right now, if you did this last year or the last couple of years, your window was really compressed because everything's coming due in 27. But the new version, you've got a big longer time horizon on it.
That's true. I know still people got 2 years of deferment. That was in 24 that we did the project. But anyways, there's another question from Rao. Can you carry forward passive losses or bonus depreciation to future years? I think Vince mentioned that already a couple times. Yes, the answer is yes to that. So Vince, I know it's such a wonderful conversation and very informative for everyone. So can you explain the intent behind the section 469 too? Because it's coming up a lot these days and everybody's talking about it like more often than before. And then earlier you mentioned, grouping the activities. So if you can shed some light on that, how the grouping works, can you make them active to offset your active gain, or can you make it passive to offset your passive gain? So, and also you already touched a little bit on the material participation as well. So if you can, share your insight on that as well.
So code section 469 is really just where passive loss limitation rules lie. And as I said, it passive losses are in place. They were put into place in 1986 under the Reagan administration for the sole purpose of kind of limiting what wealthy taxpayers could do. Because back in the day, way before 1986, you could have big losses in real estate and offset it against your W 2 income with no restrictions. So 469 came into place to limit that. So this is where you have the passive and non passive rules. That's where the real estate professional and the material participation status rule is within that code section. So there's no need to kind of know the code sections of what those are, but when we're talking about passive or non-passive laws, we really are talking about code section 469. But just to remind you, and what you really need to know is, if you have a passive loss and you want to unlock it, you got to be a real estate professional, which is the big circle. You got to spend 750 hours in an activity, and you have to spend 51%, 50% or more of your working time. They call it personal service time, but think of that as working time. So if you're on a W-2 working full time, it's not going to happen. I'll show you court case after court case where it was denied. But if you have a spouse that can qualify for it, they don't have to meet that 50%. They then just have to get the 750. But even if you meet all of that, you still have to prove material participation, which is a smaller circle, which what that says is you're just actively participating in managing your rental properties. And of the hours that qualify for material participation, these 750 hours qualify too. So, if you've got to get 100 or 500 hours in material participation, these are all one and the same. They're not different. The only challenge with material participation is you have to materially participate in each of your rental activities or each of your passive activities to unlock them. Real estate allows you to group all of those activities together. So instead of proving working 500 hours in 10 properties, you can group everything together as one. And as long as you get your 500, which is a part of your 750, you would unlock all of those losses.
Interesting. And then does that time spent on analyzing deals, going to meetups, being on calls like qualifying investors, does that qualify as a rep status too or
Not
no?
quite. Just sourcing deals or underwriting stuff doesn't qualify. You got to actively manage on that, which means that in a sense of a LP or a GP situation, I mean, you've got to be able to raise capital. You've got to be meeting with property managers. You got to be overseeing CapEx, that sort of stuff. That would qualify. But the actual going to meetups and networking, that would not qualify. And the same thing goes back to the Airbnb and the material participation and all of that. Those have to actually be activities to one specific property.
Oh, thank you. So I wanted to remind everyone if there's any question, please use the Q&A box now. And I think there's a follow-up. If I'm only raising capital, would that qualify?
Depends what you're doing with that, but GPs have a whole nother opportunity of ways you can structure those either asset management fees or acquisition fees or all of those sorts of things that you can get. But just purely raising capital, if that's all you're doing and you're sourcing that into another deal, that technically is not. So, like if you and I got together, Vinky, and we raised $10 million and we put it into someone else's deal who was managing that property and overseeing it, we're really just capital raisers. We really have nothing to do with that property. Now, if we are the GP on that apartment complex property, that changes the stakes of the game. But purely raising capital is not going to qualify you for uh, real estate professional status in that sense. That's not to say that you don't have opportunities there to structure some passive income, to do some creative things, to carve out some opportunities for you so that you can then realize those losses, but just merely raising capital or not. may not qualify for that.
Great. Thank you so much. So go ahead and get on with the next slide. And I wanted to remind everyone, if you have questions, please use the Q&A box. Thanks, Wayne.
Yeah.
Go ahead.
Yeah, well, I mean, this is just kind of hitting back on everything we were talking about, but what you should do before you act. You really today is a good starting point, and obviously, if you've never heard this before, it's probably like drinking out of a fire hose. It seems like there's a lot of information there, but your goal as an investor is not to be the tax professional, and as much as Vinky knows about this stuff, she can't advise for you either. You've got to take an active stance in your own things. You've got to work with a professional that knows this stuff and can help guide you. And that's what we do. That's what we pride ourselves on, and we're happy to help anyone out there that we can help with. But if your CPA is knowledgeable in this sort of stuff, then use them to their advantage and get some answers from them. But W-2 income alone itself is tough to um, plan for. That you've got the fewest options of the tax code out there. If you've got a business, you've got a wealth of things that you could do, from reducing down your taxable income. But if you're on a W-2, it gets harder. That does not mean it's impossible. We've got a lot of deals that are outside of real estate that we can show you that can significantly reduce down your income. But the main thing you need to do is just educate yourself, or work with somebody that takes the time to educate yourself. And before you get into these deals, or if you just think you want to run out and buy a property just to take the tax advantages of it, you really need to know the rules so that you don't get stuck into a situation where you think you were going to recognize tax benefits, but maybe you never did because they were categorized as passive. And that would be discouraging if you were really relying on these tax strategies for that and you missed out on that. So um, again, when you're looking at your tax returns and your tax rates, we're not looking at a timeline or 1 year. It's really the broad scope of several years, and that's where layering your investments and categorizing your income, unlocking passive losses in whatever variety we could do, exit planning, as you guys were talking about with depreciation recapture. That's all important. And it can be planned for, and the more time you get out in front of it, the better, right? If you start planning today, or if you start planning later in Q1 or Q2, you're going to be way ahead of the game versus trying to wait till Thanksgiving to call up your CPA, and they're already busy with everyone else who was proactive before you. Or God forbid you're calling me on January 2nd, 22nd saying, "Hey, we had a multi-million dollar exit last year. What can I do to save taxes?" Well, not much. Your window's closed. So, be proactive, and it will do benefits for you. We can get you to this sort of situation where you can turn 10K into almost $500,000 with with proper planning and those sorts of things. So um I I can keep talking as long as you want me to, or I can
Yeah,
share my
sure. I
slide
think this
deck
is
with you.
yeah, share more. And then I think for the high income earners, especially on the W-2 employees, if you have more strategies that you can share with us, that'll be super awesome. I think I did send you a few of my investors last year, if you remember, in December, because everybody had the same question. And unfortunately, I didn't have the answer for them.
Yeah. Yeah. Well, I'm always happy to help and always happy to take a look at it. Um, I don't know what kind of timeline we have here, but if you want to see some real case scenarios, we've got a couple of things here. This is an Airbnb example of a couple that they made about $861,000 annually. Both the husband and the wife worked, and they were in a situation just like we're talking about, where they're investing into multifamily deals and they're not able to see those losses because they're tracked as passive. So we started strategizing if it made more sense for the wife to stop working and become a full-time real estate professional. We were able to model that out and show what that would look like. But in the end, what they ended up doing in the very first year, because they weren't ready to retire, is they got an Airbnb that generated in year one. I think it was probably about a $500,000 Airbnb, kicked off a $82,000 loss from cost segregation in year one. That saved them $30,000 just on the Airbnb purchase. And through some other strategies that we worked with them for, we were able to save them $43,000 in year one. And that's money in their pocket that they can then have to start working for them to invest into other deals, to improve that property, whatever they want to do. But this was an exact situation where we had a couple that was getting limited by passive losses, and they used the Airbnb short-term rental to unlock that, and it got some sizable losses for them. Um, Another situation here, it's been a minute since I looked at these, so forgive me. So we had a client that had a multi-million dollar exit. Private equity came in and bought their pest control business. So they were faced with a lot of situations, whether it was um, state tax issues and obviously the federal income tax issues of this. So what we were able to do was one, restructure some of their entities. The way your businesses are taxed are really important to the way your business are structured. So we are able to restructure some of their businesses so some of that flow through income can be taxed at a lower rate. Obviously, sometimes tax planning is not about eliminating all the taxes, but if we can get it from a 37% bracket to a 10% bracket or a 20% bracket through a variety of ways, whether we convert ordinary income into long term capital gains or we pay our kids and get tax-free income. Those are all shifting strategies where we can move income out of a high bracket and into a low bracket. So with all of these things for this particular situation, for this client, we were able to save them a total of almost $300,000 in state and federal taxes by working proactively with them to plan for this exit. And by the way, this exit was, it was going to be a couple of years away. This is something we worked on to plan for. And when that exit happened, we had all our ducks in a row. We weren't reactive. We weren't trying to structure and run down and buy the first beach property in 30A that the client could find just because he had extra money. He was able to smartly, efficiently do that. And we had all sorts of strategies, from short-term rental strategies to conversion strategies to shifting income out of state income into lower income states. And that's where we really provide our biggest value to clients, is really working with them in these situations and showing them how we can really help them out and do more for them.
Great. So I'm going to ask you this question, Vince, over here. I get that a lot. A lot of people, they just think like how much I should spend on CPA. And then you already highlighted, this tax sheltering, I would call it, or the tax planning or doing your taxes at the end of the year. This is just not like a one-time activity in a year, just like a year-long thing, the bookkeeping, you're keeping your budget, you're doing your profit losses, everything, just putting on into one spreadsheet or if you're doing it mentally, in your mental map, whatever, and trying to figure out a strategy for yourself. There's a lot involved in that. And like as Vince already mentioned, because if you're not expert at that, you wanted to get expert help in that to help you strategize better, which I do. And then believe me or not, I do have a couple CPAs already, on my personal side, on my business side that I work with, and still I feel like it's such a chaos for me. So at this time, Vince, I'm going to ask you this question. This often comes regarding the cost, Can you walk us through how you think about the cost of tax planning services and how clients should evaluate the value they receive in return? Because most of the time, people just like shy away, just looking at, oh my God, why do I have to pay this much? But they don't realize that how much they're going to be saving when they have the alignment with the right resource.
Yeah, I mean, I'm not going to pretend that some of our tax planning services aren't expensive because they are. But if I could come to you and show you a value proposition, I am going to save you $300,000, not 10 years from now or 5 years from now, but next year, you're going to be able to reduce your estimated taxes throughout the year. What is that worth to you? If I told you that you would make a $20,000 investment and it would return you $300,000 in the next, year, I would make that deal every single day. Now, that's not what our fees are on every single deal. They're just based on complexity. But in our tax advisory services, that really is fundamentally how we show our clients that value proposition. Obviously, we want to be at a situation where it makes economic sense to both them and us to do that work because whether it's a $300,000 plan or it's a $48,000 plan or a $10,000 plan that we're saving our clients on, the work is roughly the same. So we've got to make sure it makes sense to them. And I'm not going to charge somebody $20,000 to then save them $25,000. That's not something that makes sense. But our advisory services usually, on average, start at around $7,500 and just go up there from complexity. And to meet that, you've got to be able to, probably be in the neighborhood of probably a $40,000 tax savings before we'd even make it a presentation to you just because it's a lot of work and we want to make sure that juice is worth the squeeze. And like I said, our client success is our success. I want to be able to provide them with a lot of value and them have a good 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 relationship with us. Now, our compliance work, all that is built into those fees. But, if you're just coming to us for just tax returns, depending on what it is, whether it's personal or business, that could be, on the lower side of maybe $1,000 or so and just go up based on complexity from there. But our higher value strategy sessions, we do offer free consultations for that to see if you fit and to work through that. But there's, I mean, the value proposition is there. So it's, the old adage is there's nothing more expensive than cheap tax work, right? So I've been doing this for 25 years. I've seen a lot of tax returns in my day, and some things that come through our office are really they're big red flags to the IRS that if they haven't got it audited and things disallowed, they're on the verge of it. Obviously, everything that we do and recommend, we've got to be able to substantiate, and we will represent you in the course of an audit. I always say I'm too pretty to go to jail. I wouldn't do very well in prison, so I am not going to do anything to put myself there. So, just if that alone, honesty is our one of our core values that we live by. So we do have to substantiate everything, whether it's code section 469 or what have you. We've got to be able to stand on our own two legs with this, with the Internal Revenue Service or the state revenue departments and anything that we recommend. And that's first and foremost.
Yeah, thank you for sharing that. And I would say one thing over here. So there is a difference between the tax preparer and tax planning. Because you are the tax planner, you help with the planning. Prepare is just like you give them everything that just fill out all the paperwork and send it in. And I think there's much beyond that, the services that you provide. I mean, I can tell from my personal experience. So there's another question. How do you lower annual income taxes if you earned $10 million annual income? I'm thinking of a very large income, not necessarily 10 million specifically.
Well, I mean, the way I would tackle that is first, how is that 10 million taxed? I mean, is it coming through as a capital gain? Is it on a W-2? Is it a business? All of that depends on our strategies and what we can go through for there. I mean, um, I've got another slide deck that I could pull up, but basically you got five ways to reduce your taxes. One is deductions. If you're in a business, any deduction you can do to lower your income, that will lower your tax rates. You've got what I said earlier, which is conversions. If you can shift income from a 37% bracket down to a lower bracket, you're winning, right? So if we can convert, if this $10 million is getting taxed at 37%, and somehow we can shift this into a long-term capital gain, not saying it's possible, but if there is a way to do that, and for GPs and carried interest, that's obviously a massive thing we can do and unlock all the time. So conversion, that could mean a lot of things too, from paying your kids that have a 0% tax rate. It could be deferring your taxes, kicking that can down the road. We can do that with all sorts of things, whether it be 1031 exchanges or investing in life insurance or a lot of different strategies. Or, if we can altogether eliminate that income, that would be phenomenal if we could do that. It's just when we look at tax advisory, there's no one answer that catches everything. It's really, we've got to know what the client is doing today. We got to know what their plans are for tomorrow, where their strategies lie. If you tell me you've got a big diversion against oil and gas because your dad got burned in the 70s because he was a part of Exxon, and Venezuela took all their billions of dollars of assets, and you'll never invest anything in the oil and gas, I'm not going to spend any time on that. But we want to go in depth with our clients and know them and know what their interests are, and then try to align as many strategies with them or whatever they have as possible, because that's what's going to benefit them the most.
That's true. And each person's situation is different. Thank you for sharing that. But I'm going to ask you one last question. But
Go
before that,
ahead.
let me ask the audience if you have any question, this is your time. Use the Q&A box because Vince is still here. So you can ask your question. So Vince, one last question. If or when somebody's shopping for a good CPA, what question they should or must ask, not should, what
Yeah.
question must be asked to just to qualify the person or just see if there's an alignment.
Yeah, yeah. Well, I mean, obviously, do do they have capacity? I mean, it's one thing for me to sit up here and sing all these praises and you fall in love with me, and then you get stuck with somebody on my team that you don't like, or somebody on if you go to the big four, you're not working with a partner, you're working with one of the junior staff, and you're not getting that same level of service. So, you want to know who you're working with, and do they have capacity? Do they have expertise in what it is you're doing? Like you said earlier, fortunately or unfortunately, a lot of advisors are really just filing tax returns and doing compliance, and they can't get off that wheel. So if you're what I would really want to know is what's their expertise, what's their history, what have they done for other clients in similar situations to yours, and do they have the capacity for to take you on as a client?
Thank you. So I do not see any more questions. Can you share one more time how people can reach out to you? Because that's the
Yeah.
most important question now.
Of course, yeah. So I had that up there, but if you want to book a call, you can hit that QR code. But you can find me on LinkedIn. It's Vince Porter, CPA. Or if you want to reach out to Vinky, she can connect us. Or my email address is Vince at mytexascpa.com.
Thank you, Vince. And I do not see any more questions. I think that was very, very informative and insightful session, I think. And everybody might have enjoyed it because usually we have 60 to 90-minute sessions, and usually we cut off at 60 minutes and see everybody's still here. And they're obviously enjoying and, you know, absorbing all the information that you're sharing with us. So thanks again, Vince. Appreciate your time and your insight. And everyone here who's with us, thank you so much for joining us. And remember, the goal is not to eliminate the taxes. It is to eliminate the surprises. Basically, we call it, that's why we call it tax planning. So we are not just preparing the taxes, we are just planning it throughout the year, trying to figure it out and working the strategies in our favor. So we'll see you next time with another valuable conversation with another awesome guest. Bye for now. Thanks, Vince, one time
Thank
again.
you.